I'm Steve Forbes, and you're watching Traders Nation.
Welcome back. You are tuned in to Traders Nation. My pleasure to have back with us once again Sam McElroy, co-founder at Financial and at Financial Investments. Sam, welcome back to Traders Nation. How are you today?
I'm doing well. How are you?
Doing great, thanks. So, fourth quarter GDP was revised lower, not by much, some would think, but certainly enough to get attention, to 2.5% from 2.6%, despite stronger spending. Markets seem kind of unaffected by it. Sam, your thoughts?
Yeah, I would kind of echo the same sentiment. You know, it's not uncommon for, you know, projections or current data to get revised downwards or even upwards sometimes, depending on, you know, lagging data that comes in. So when we look at the fact that it was revised downward, it is significant because it's a downward move, but it also was a slight one. It moved from 2.6 to 2.5.
Yeah.
And I think you're absolutely right that the market seemed relatively unaffected by it.
Sure.
I think it, in a sense, it being the market, has kind of bigger concerns that it's looking at these days.
Right.
So I think we just have to keep it in its proper perspective that it's all meaningful, it's all relative, but there's more afoot kind of going on.
Sure. That's
probably going to be more impactful as far as market movement.
So in essence, you know, it's not necessarily this slight fractional downward movement. It's not the size of the move. It's actually the direction of the move is what they're poo-pooing about, right, Sam?
Yeah, pretty much. You know, one of the things that was promoted and that we were initially looking for was improvement from a GDP standpoint.
Right.
Going back to 2016, there was a lot of talk of, you know, trying to get the GDP growth up to 4%.
Yeah.
I think since then, most analysts have kind of come back and said, okay, that's not really realistic, but certainly if we can see positive growth in GDP, then we'll take that as a win.
Yeah.
So anytime you have GDP, which is one of the major metrics that people are looking at as far as how the economy is performing or improving, and that gets revised downward, I think the fact that it moved backward is sometimes of a letdown.
Sure. And that got people concerned. I don't blame them, right? I don't blame them. Wrong direction, certainly. Some of that came from spending of goods, inventory, investment. But aren't businesses? I mean, come on, man. Inventory, it costs businesses money to buy inventory for it to sit there, for it to go back out the door again. So, I mean, aren't businesses smarter and much leaner today? I mean, the technologies makes us leaner, makes us smarter, right? So what's so wrong about that? Right?
I don't know if there's anything. Yeah, I don't know if there's anything so wrong about it. I mean, certainly, businesses are looking for every advantage that they can utilize, and you know, whether it's better integration between different types of businesses, being able to share pool resources, whether it's, you know, technology driving logistics and inventory, all of that is going to be impactful, and businesses, you know. Businesses are going to be more concerned with their bottom line than what it does to the GDP, and I think rightfully so.
Yeah, most businesses have to be smarter. That equates to a better net bottom line and longevity and staying power, doesn't it, Sam?
Yeah, it typically does.
Okay.
You know, what businesses are always kind of looking at, and there's a number of different metrics, but obviously, you know, they're not just looking at their profitability in the sense of, you know, how much revenue did we have come in netted against cash flow, but especially larger businesses netted against expenses. But larger businesses are also looking at, you know, how much cash do we have on hand? How much inventory do we have? What are our future projections? And what do we think those carrying costs are going to be? You know, what retained earnings do we have? So they're playing kind of this more complicated math game of trying to make sure that they're as efficient as possible so that ultimately they can increase revenue.
Yeah, and all those factors come into place, folks, because, listen, the inventory is important, but it's such a huge picture of what they're looking at. And let's face it, too, Sam, the Tax Reduction Act also brought into play. Businesses said, hey, we can save some money. They had the calculations already done, right? And they knew where they know financially where they wanted to grow to. So now they had the financial means with tax breaks to do that. Hire people on, grow their business, get into areas maybe they were thinking about before, but now it makes sense to do it because maybe the cash flow is a little bit better. So let's move on, because we saw an increase in equipment spending. So that kind of reflects that train of thought that you were just talking about, does it? In fact, it was a 6.6% increase in equipment spending for these companies. Sam?
Yeah. So I think there's a lot of things that's happening simultaneously in the market. You know, what we also have to couch this in is, you know, we've had some recent jobs numbers and other stuff like that, and so we're seeing that, you know, unemployment and the job numbers are continuing to look strong.
Yeah.
I think that has ushered in this whole conversation of what's going to happen with respect to inflation. And it's a circular kind of argument. On one hand, you say, well, you want the economy to grow. We need the economy to grow.
Yeah.
But what that happens when there is lower unemployment is that corporations or businesses are forced to have better incentives to try to keep their workforce, because the workforce can start to demand more for what they're doing. There's plenty of jobs out there.
Sure.
They can go out and do that.
Yeah.
So now we have this conversation of, okay, well, how does that then get combated? Well, if there is inflation, now we're looking at interest rates, and our interest rates going to rise.
Yeah.
What we've seen, though, recently is that even though the unemployment numbers have been good, wages haven't really increased that much, and so inflation has kind of been held in check.
Yeah.
I think that all these numbers are ultimately what's going to be a little bit more impactful for the direction of what the market's going to do than looking purely at what's happening with GDP. And to that same extent, I think businesses are looking for an advantage to be able to gear up to basically grow and expand. And I think that's why you're seeing larger sales with respect to equipment.
Yeah, it almost becomes a buyer-seller market between businesses and employees, correct? I mean, it's like the demand is greater. You want to keep great people, and you want to attract great people. So, yeah, I can see how that can come into play with inflation. But the Feds may come in and stomp on that. We're looking at 3 potential raises throughout the year to try to get inflation in check. Some say inflation's already here. Your thoughts in regards to the Fed on that?
Yeah, I think, and I don't remember the timing exactly, but maybe about a month ago, there was this really interesting synergy. You had Powell, who was talking before Congress, one of his first times doing so, but then you also had some of the older Fed chairmen that were actually talking and giving talks simultaneously. And so it was an opportunity for us to be able to kind of garner, I guess, multiple different perspectives.
Yeah.
Based off of what Powell was talking about, he seems like he is very much intent on continuing to have a couple rate increases this year. But I do think that there's a ceiling on how fast rates can grow.
Yeah.
I think that as long as long-term rates aren't necessarily growing quite as fast, we have to be careful that we don't flatten the yield curve. And so while I think it's important to get interest rates moving upwards, because we've been in this kind of prolonged low interest rate environment for a long period now, I think there's a lot of pieces that have to be monitored to make sure that when you flip a switch on one side, you're not inadvertently causing ripple effects somewhere else.
Yeah. Sam, what we need to do is we need to find Greenspan and see what shoes he's wearing, okay? Because I think that's the bellwether, okay, the benchmark, Sam, if you will, of what's going to happen between now and the end of the year when it comes to the Fed and the rates, rate hikes. All right, we got probably about a minute and a half. Overall, virtually, I mean, there's been no changes in regards to movement in GDP. But what I want to do, we need to really focus on the first quarter on GDP. Kind of a follow-up to the fourth quarter, what happened there. That's going to kind of give us some outlook of what this year is going to look like, is what the first quarter of 18 on GDP. What your thoughts on that, Sam?
Well, I haven't seen a whole lot of data so far as far as what they're thinking GDP may look like in the first quarter. I think the last times I've seen it, it's expected to be about the same.
Is it?
Somewhere between 2.5 and maybe call it 3% or so.
Sure. Maybe.
I don't think we've seen. Oh, sorry.
No, go ahead. You don't think we? Yeah, go ahead.
Yeah, I don't think we've seen anything that's happened so far that has halted GDP or that would expect it to be substantively lower.
Yeah.
But I think one of the things that we all are keeping our eyes on now is what's going to happen with some of these tariffs and other things that could have some impact on business.
And we'll have to cover that on another edition of Trader Nation. All right, Sam, where can we find you at?
Easiest way is probably the website, the www.atfinancial.com.
All right, head on over to that website today. Sam, as always, appreciate your time here on Traders Nation. You have a good rest of your day.
All right, you too.
You bet. All right, stay tuned. We'll be right back.